Hello, everyone. Welcome to our May Realosophy Realty Move Smartly Market Update. My name is John Pasalis, president at Realosophy. As always, I like to do these, these monthly updates, unpack some of the latest trends in the housing market. Going to go through some stats and trends that I do not publish in my monthly report. For those of you who haven't seen it or don't read it, it's at movesmartly.com. Just click reports. I write a monthly look at what's going on in the market. So some of these trends are in there, but some charts are a bit different. Before I move on, I thought I'd kind of ask a quick question. I mean, part of this, of course, is to give everyone an update, but also to answer questions as they come in. One thing I was wondering recently is, would it be better for people if I did these in the evening, one day of the week, I don't know, 6, 7 o'clock, when people are more available versus sort of lunchtime when I've been doing them. If you can post your comments either in the chat or in the discussion below, if you're watching the recording after the fact, that would be great. And depending on the feedback, I'll adjust the time accordingly. Here's a quick update on what I'm going to be talking about today. Of course, a market update on the condo market and the low-rise house market. I'm going to kind of show a few trends of the differences between houses and condos, and a couple of charts to just unpack how the market has really changed over the past 6 months, because it's been pretty wild. And then I'm going to bring on David LaRocque, as usual, as mortgage broker, talk about the latest trends in the mortgage market. So as always, you post your questions. For anyone who has any more specific questions, feel free to wants to connect with me. You can go to movesmartly.com/meetjohn to set up a buyer/seller consultation, where we can kind of talk about more personal questions in a little bit more detail, because the chat obviously and the Q&As we get are more general market questions. Now, before I kind of move on to the market trends, I just wanted to highlight over the next week or two, I'm going to be launching a free 1-hour webinar on top 10 home buying strategies that are going to give buyers an edge in the market. A lot of this is driven by a lot of mistakes that I see, quite frankly, a lot of buyers making. I mean, I'll give you one which just killed me, and it's a very frequent one. I mean, on one of our listings recently, we had 10 or 11 offers on the offer night. And it was quite interesting because 7 of the offers that came in were actually not even in the value range of the home, and it's very common. When we're representing sellers, like a lot of other agents, will sometimes price a property less than what it's worth, expecting to get a price that is above the asking price. But how much above depends on, obviously, what the property's worth. And a lot of agents out there are not really doing much homework. They're not understanding and advising their clients on what the property's actually worth. So you have all these people bidding on homes that are actually the ones they can't afford because they're not in their price range. So, 7 out of the 10 agents were not even making competitive bids. 3 were because they'd done their homework. So there are a lot of buyers out there spinning their tires, wasting their times, because quite frankly, they're not getting the right advice. So I'm going to be kind of promoting this on our YouTube channel and our podcast. So keep an eye out for that. And it'll just be really strategies that'll help buyers going forward, just to make more informed decisions. So kind of moving on, I'm going to kind of give a quick update on what is happening on the market for houses. So this is low-rise homes, semi-detached townhomes. And the big story this month, again, continues to be very, very low level of new listings. So when we look at the number of new, so I'm going to actually, these couple of charts I'm showing here are for detached properties, not all low rise, I should clarify, because when we break it up by detached, we can kind of look at a far more historical, longer term view back to 1996. And the number of new listings for detached homes in April of 2023, last month, was 5,292. So just about 5,300 new listings. Ignoring the poor level of listings volumes in 2020, which was really like the first full month of the COVID-19 lockdown, ignoring that month, and that was obviously an outlier, The last time we've seen listings levels this low is actually in 2001, when we had 5,500 listings, and that was obviously a little bit above what we have today. And we have to go a little bit further back to 2000 to a level that's below where we are today. So we've got a 20-year low in new listings, and this is really contributing to some of the dynamics we're seeing in the market for houses. When we look at sales, sales are also relatively low. I mean, there were about 3,400 home sales, similar to last year when the market had turned, quite similar to 2018, which was a very slow market. So sales are actually well below, I'd say, historical levels. We can see for the month of April, you know, and you know, this is a factor. But I think one thing to keep in mind is when we look at sales volumes, are sales low because there just aren't buyers out there, or are sales low because there isn't a lot to choose from? And certainly, I mean, when we kind of went into this year, most of us thought that sales would remain low because there wouldn't be a lot of buyers out there looking at properties. And that is, in fact, not at all what's happening. Sales right now are being constrained by the fact that there aren't a lot of homes to choose from. And the best way to look at this is not even looking at new listings, it's looking at the number of active listings on the market. If we look at the number of active listings that were on the market for detached homes at the end of April, we had 4,500 detached homes available for sale. Even if we go back to 1996, there has never been a year in that entire time period where the number of available detached home listings were this low. And this is really what is impacting the market right now. It's just this tight inventory. And of course, when you don't have a lot of homes to choose from as a buyer, you know, you're going to have constrained sales. And this is partly why we're seeing offer nights with like 5, 10, 15, 20 offers on them, why homes are selling so quickly. You know, because, you know, I would say the demand is not insanely strong. I mean, obviously, we're not quite where we were last year, but the demand is pretty decent considering where rates are, but there's just not a lot to choose from. So what's happening is the market is really responding to the lack of listings. And because of that, we're seeing all this competition. And when we look at sort of a metric we call the months of inventory, which just basically takes the number of homes available for sale divided by the number of properties that sold in the given month. When we look at all low-rise homes, and this includes semis and row houses now, we're just over 1 month of inventory over the past 2 months. So 1.2 months for low-rise homes. And because this is such a very tight competitive market, we are actually seeing prices increase for low-rise homes. I mean, low-rise home prices have averaged around 1.3 since July, and they stayed like that until the beginning of 2023. But they've been trending up, and in April, we were just above 1.4 million. And if you actually look at the weekly stats, they've actually we're on an upward path. Like we're close to breaking like 1.5 probably by the end of May if things continue at that rate. And again, a lot of this is just driven by, and I've been in the press, I've been kind of, I spoke on BNN Bloomberg about this and the Financial Post recently, is that like in some ways like this fear of missing out that a lot of buyers are starting to feel now, especially if they're competing for a home in some of the suburban markets like Durham that are very competitive, because, you know, anyone who started their home search, you know, 2 months ago sees how prices have increased over those 2 months. And this is, you know, creating a bit of anxiety for some buyers. They feel like they need to rush in and buy because they're worried prices are accelerating. You know, and this is leading someone, after you've lost 5, 6 offers, you know, you start getting a little bit more aggressive in your bidding. And this is partly what's contributing to the increase that we're seeing in home prices right now, especially in the low-rise market. Now, if we move on and, you know, again, please post your comments in here. We're going to go through them. After I go through the market update, before we go through some of the other slides, I'll hit pause and have Urmi from Move Smartly kind of walk through any questions we might have that might be relevant. So please post your comments in the chat. We'll definitely kind of gets to them. Turning to the condo market, sales for condos came in at about 3,400, which, you know, is sorry, this is new listings. New listings for condos came in at about 3,400, which is, you know, in line with 2018, 2019. I mean, it's below traditional levels for the month of April, you know, which is probably in the, you know, mid 4,000s. But not quite as soft as what we've seen for the low-rise market, for the market for detached homes and semis. And then when we look at sales for the month of April, again, sales came in at just over 2,000 for condominiums, which is, you know, again, somewhat in line. I mean, there are months in April, especially in 2021, which is kind of the kind of the one of the big bull runs in the COVID boom, was sort of this late 2020 and early 2021 period, where sales were higher. And similarly in 2016, 2017, where we're kind of had this housing bubble in the GTA. But sales are relatively normal, I'd say, for the condo market. And when we look at inventory levels, I mean, just under 4,000 condos available for sale, you know, slightly above the most recent 5-6 years, well below the periods before that. I mean, we can kind of see there's a big shift in the market where, you know, before 2016, we would have typically just over 5,000-6,000 condos available for sale. Now it's just under 4,000 for the month of April. Probably a number of different factors that are contributing to that, but I don't want to dig into that too much. But the point is, the market is relatively more supply a bit better than the market for detached homes, which we saw is the inventory levels were at their lowest since, I mean, ever on record since 1996. Now, when we look at the months of inventory for condominiums, again, they have been falling since the start of this year, are just over 1.6 months. And condo prices, you know, they've picked up a little bit over the past couple of months because we had this dip in December and January, but have been pretty flat when we compare them against, you know, fall prices, you know, average prices in October and November. So the condo market is competitive. It's not as crazy as the low rise market. And I'm going to show some stats actually in this next slides that kind of unpack some of the differences by house types. Before I do that, Urmi, I don't know if we wanted to go over any questions or if we should keep going. All right, maybe we'll.
Sorry, John, a little slow there. We have a few questions. They cover both house and condo questions. Did you want to do this section and then we'll get into them?
Yeah, okay, sure. I'll do the next couple sections and then we'll go through some of the questions for sure.
Yeah, some great questions coming in about the market right now.
Yeah. So before we bring Dave on, I'll go through the next couple of sections where we're going to talk about houses versus condos and really how the market has changed recently, and then we'll kind of go through some of the questions. Sounds great. Okay, so when we look at the market, when we compare the market for low-rise homes versus the market for condominiums, we see these very big differences. So if we look at the months of inventory for each, and again, the months of inventory is just the number of homes available for sale divided by the number of homes that's sold, which means the higher the months of and how long it would effectively take for all the homes to sell, assuming no new homes came on the market. So if a market has 2 months of inventory, it basically means if no more homes came on the market, it would take 2 months for the current stock of homes to sell. So the higher the months of inventory, the slower the market, the longer it would take to sell. The lower the months of inventory, the more competitive the market is, and homes are moving very quickly. So when we look at these, there's a number of things that stand out when we look at the trends both regionally and across house types. So for starters, the low-rise market for houses, months of inventory levels are well below what they are for condos. I mean, we saw that in the previous section where I chatted about how low-rise homes have on average 1.2 months of inventory, condos are closer to 1.6, 1.7. And we can kind of see that across the board, that is consistent across all the regions in the Greater Toronto area. Houses are more competitive than the condo market. And then when we look at, you know, which house regions are the most competitive, interestingly enough, Durham has the lowest months of inventory right now, under 1 month of inventory. Toronto is just under 1.4. And again, Durham, I think one of the reasons it remains one of the most competitive, is super competitive during COVID. It is because it is probably the most affordable region in the entire Greater Toronto area. So if you want to buy a detached home, Durham is the most affordable region where you can get something either under 1 million or just over 1 million, which is a lot harder to do in the other, I mean, certainly not in City of Toronto, but even a lot harder to do in York Region, Peel, or Halton, regions that tends to be a little bit more expensive. So this is why I think Durham is kind of, again, the most competitive market. Toronto and York regions have the more inventory, partly because they're more expensive. Now, when we look at the percentage of homes that are selling for over asking, which again, I think is a measure of how competitive the market is, we can kind of see Durham, when we look across the regions, 70% of homes in Durham are selling for over asking. Very competitive market. Toronto and York, despite having more inventory than areas like Halton and Peel, are still above them at 60%. And the condo market is a lot lower across the board. You know, areas like Durham, interestingly enough, again, you know, about 47% of condos are selling for over asking, whereas in Toronto, Peel, and York region, we're in the 30% range. So again, this is a measure of how competitive the market is. You know, property selling for over asking is not just about how agents are pricing them. You're not going to sell for over asking if the market isn't competitive. And we're actually going to see that in this next section I'm going to look at, just to wrap up, to unpack how the market has changed in just 6 months. Okay. When we look back, I'm going to compare two statistics in the GTA's market from October of 2022 in the fall market 6 months ago versus April of 2023. So we're going to start again by looking at how the months of inventory has changed. You know, again, this is an indicator of how tight the market is, how tightly supplied it is. The higher the inventory, the slower the market. And when we look at that, we can kind of see how inventory levels have plummeted in 6 months. I mean, Durham was around 1.7 months of inventory. It's now under 1 month of inventory. Halton was about 2.7. It's now 1 month of inventory. And all of the regions were, aside from Durham, every other region had over 2 months of inventory, and inventory levels have plummeted since then. And again, this has really contributed to the intense competition that we've been seeing over the past while. So when we look at the percentage of homes that are selling for over asking and in these regions in October of 2022 versus April of 2023, again, this has changed dramatically. I mean, in Durham, just over 40% of homes were selling for over asking. Now it's 70%. In Halton region, about 15% of homes were selling for over asking back in October, and now it's just under 50%. So again, this is another indicator of when we look at, we try to use this statistics of a barometer of how competitive the market is. You're not going to have 50 or 70% of homes selling for over asking when the market is sluggish. So these numbers have increased significantly, in part because the market is so much tighter today than what it was in October. So that's a little bit about sort of the regional trends that we've been seeing. I don't know if we want to go through, what time is it? 12:20. Let's go through a few questions before I kind of wrap up on another couple of issues.
Great. We have some great questions in here. Let's start with the first one from Classique. Hi, John. Do you think now is a good time to sell in Toronto?
Oh, I mean, these are hard questions because, selling is a personal decision. You sell if you need to move. If the concern is, in some sense, yeah, selling it today is better than what it was 6 months ago. You're getting a higher price. You're going to have probably a lot of competition. So if the question is, these are hard questions because I don't know if they mean, are prices going to be better? Should I wait till the fall? You know what I mean? And this is, of course, an impossible question to answer and predict. But the market right now for sellers is very competitive. Like, we're in a deep seller's market. And we don't know how long that's going to last, or if that's going to change as we move into the fall market. But yeah, and where prices are going to go, quite frankly. But yeah, I mean, as a seller, this is the seller's market, quite frankly, right now, and it's harder for buyers today.
Thanks. And from Lelia, hi, John. I'm looking to upgrade from a semi-detached in Mississauga to a fully detached, probably in Hamilton. Should I buy first or sell first? What are some of the key considerations? Thank you.
That's actually a great question, and something I'm probably going to go through in the webinar I mentioned. So there's pros and cons to buying and selling first. So most buyers typically, or most people a lot of times, will buy their next home first and then sell their current home after they've purchased. The advantage of doing that is you can take your time to find a home to buy. Usually it is a lot harder to buy a home than sell a home. Like, it might take you 3, 4, 5, 6 months to find the home that's right for you. And if the market's competitive, your home should sell pretty quickly. Now, the disadvantage of buying first is there are a couple of them. Number one, if the market turns quickly, like if you're not really paying attention to the dynamics in the market real time, you could be selling in a market that is a lot slower than when you bought. And this happened in 2022. Prices fell in sort of from about March to July of 2022, mainly because a lot of the people who were selling at the time had committed to buying another home, and then went to go list. All of a sudden, there weren't as many buyers as they expected or were hoping for. And every week, every seller was basically selling for 25 grand less than what their neighbors sold for the week before. Well, in a month, that's $100,000 decline in prices. And if you do that for 2 months, it's 200,000. So, there is this risk of what happens if the market turns on you and it's a lot more sluggish. So, again, the one way to mitigate, and we actually cautioned our own clients at the time of that risk, for the ones who were buying, when we noticed that the market was turning. And a lot of times it's hard to articulate it because the buyers, our clients even, they don't appreciate these risks as much as we try to explain it to them. Everyone just assumes the market for Toronto is just going to be busy. And then when you list, and instead of getting 50 showings, you get 10, they start panicking. And we didn't have any issues. Our clients all sold and did well, but a lot of sellers didn't do well at that time. So, that is the one downside. Flipping to the other side, which is selling your home first. The advantage of that is you're not under pressure. You know exactly what you're going to get. You don't have this anxiety of selling for less than what you're anticipating. The downside to that is that if you sell, well, you have a certain amount of time to find a home before, you have to move out of your current home. And if you don't find one in time, you have to move to a rental for the short term until you find your next home, right? Now, that is the downside to selling first. Now, which approach someone should take? I mean, partly, quite frankly, it's a combination of probably 3 things. One is what's going on in the market right now, because if the market is like in the fall, we were advising most of our clients to sell first because the market was very unpredictable. Homes were sitting on the market. It wasn't a slam dunk that you're going to sell in 4 days or 1 week, right? So, 7, 8, 9 months ago, our advice was to sell first. With most of our clients today, the market is quite hot. We're more confident if they buy first that their home will sell pretty quickly. But again, this can change in 4 weeks or 8 weeks. So what's going on in the market is super critical. The person's risk tolerance is critical. I'll never forget, I was helping my parents doing the same move. My parents are very old school. And we talked about the pros and cons of each, and it wasn't even an option, right? They're basically, their reaction was, there is no way I'm going to buy a home without having sold my home. We're going to sell. I'm going to move into a condo if I have to. If I haven't found something, we're going to take our time because we lived through the 80s and we've seen the market tank. So, some people, it's just not an option to expose themselves like that. And you do expose yourself, because if the market turns pretty quickly, you're exposed on two trend properties, not one. So the person's risk tolerance is the other one. And then the last one I'd say is the type of home that the person lives in. Like, are we, when we're advising our clients, is their home the type of home that we know we're going to be super competitive, we're going to have a ton of offers and a lot of interest? Or is it the type of home that might take a little bit longer? It is unique. It's like a $2 million luxurious 2-bedroom home, that's detached, would be an example of a home that has a far narrower pool of buyers than a 4-bedroom, $2 million detached home, right? So the type of property also matters when we're advising clients. So again, it's all of those things combined. There's no perfect answer. It's just weighing pros and cons and of each approach based on each person's risk tolerance and their property circumstances and what's going on in the market. So that was a long answer to a short question. I hope that helped.
And we have another open-ended one slightly, because I know you love them. Is it a good time to buy a condo right now? I'm going to assume that ZG is talking about resale condos, given that you just shown us in your stats that they are lagging behind the price increases in houses. What would your general advice be?
Yeah, I mean, again, the question is this a good time to buy? I mean, it's a tricky personal decision. You know what? I actually might bring up a chart. I'm going to fast forward on the math for condominiums. And this is, I think, partly why condo prices are lagging compared to house prices. Condo buyers usually are doing a more direct comparison of what is it going to cost me each month to buy a condo versus what does it cost to rent that same condo, right? So in my report, I basically, and I'm going to pull up the numbers, I basically said, okay, what does it cost for an average 1-bedroom condo downtown to purchase, right? What would the costs be if I was a buyer who bought that, assuming a 20% down payment? And then what does it cost to rent? So if we look at the actual costs, so a 1-bedroom condo, and then this is sort of downtown central Toronto, costs about $640,000 was sort of the average price in April. If I put down a 20% down payment, I would have a mortgage of just over $500,000. The mortgage payment on that at today's interest rates and a 30-year amortization would be about $2,700. The monthly maintenance fees are just under $500. The property taxes are $160. So the monthly carrying costs are just under $3,400 a month. Now, the challenge is that the costs to actually rent an average 1-bedroom condo are closer to about $2,500 a month, right? So there's a very big gap between what does it cost to own and what does it cost to rent. And of course, your $3,400 a month in your carrying costs for your condo, part of that is going towards your principal, of course, like far less today because rates are so high. But this is obviously impacting the average person's cash flow. So, the question of whether or not it's worth buying, again, is a very personal one. Like, we have clients who understand the math, and, they're not fussed by the difference. They're buying it for the long term, and are willing to do it. So, and I think that's the most important thing that anyone can do. I mean, if you want to buy a condo, you should not, I mean, someone reached out to us recently and they basically said, we're considering buying for 2 years and then selling it. Well, I would say then don't buy, because 2 years isn't long enough. And the risk is actually quite high on recovering your transaction costs, and who knows where prices will be. So, anyone who's buying a condo should plan to hold it for the long term. Because again, you need some time for market to appreciate, for you to recover your costs. And again, it's going to take some time for these numbers to look better. Again, these cash flow numbers might look better in 2 or 3 years if rates decline, number one, and rents increase, right? 3 years from now. Right now there's like a $900 difference between them. In 2 or 3 years, that might drop to 400, right? And this is quite frankly what's motivating some people to do it. But again, it's a personal decision. So, you have to be in it for the long term. You have to know in the short term, you're paying a bit of a premium in terms of your monthly cash flow to basically be an owner rather than to rent a very similar unit.
Great. I know we have Dave waiting in the wings. I think it would
Yes.
be good, though, to finish quickly with Riaz's question. It's long, but I think the main question around Airbnb is short. I'm thinking of buying a 2-bedroom at 12 York. I guess the building is called Ice Condo, and my carrying cost for a 2-bedroom is about $6,000 per month, and the Airbnb rental is $350 a night with 93% occupancy. So this looks like a good investment. But the question is, can the city change the bylaws in the future and, thereby affecting the revenue? So what's your take on exclusive Airbnb condos?
I mean, I'm not a huge advocate of them. I know a lot of people do them. I mean, for starters, you cannot have an exclusive Airbnb condo. The city of Toronto, it can only be rented for 6 months out of the year if you're Airbnb-ing it as a short-term rental. So you can go longer than that if you're renting it by the month versus by the night. And I know a lot of people who have ran into issues with this, with Airbnb and with the city, because they were renting them for more than 6 months, and they've had to basically take them off Airbnb as short-term rentals and kind of move them to monthly furnished rentals to try to make up that difference. So, and again, I think it's challenging to make work if you want to get into that business. I mean, but I wouldn't rely on the assumption that you could rent them out by the night at a 93% occupancy for 12 months out of the year, because you could get burned by that. I mean, the other flip side, quite frankly, is when I talk to people who do this, virtually nobody tells their insurance company they're doing this, right? Because your insurance company is going to basically take the city's approach, and they don't want you to have it rented for more than 6 months out of the year, right? That's the most they'll allow you to kind of rent it as a short-term rental. Most people who do Airbnbs couldn't care less. They just don't tell their insurance company. I mean, to me, that's just insane because, you're effectively uninsured at that point, right? If anything happens, you're fully responsible, because if something, knock on wood, happens in your unit, a fire gets lit or some damage happens that impacts the rest of the building, your insurance company is going to basically come in and say, okay, let's look at your Airbnb history. And if they see it's been rented for more than 6 months, you're going to be responsible for that. So I would never advocate doing that personally.
Thanks, John. I'm going to sneak a quick one under the wire. This is a quick one because I know you've written about this in your report. You've talked about the market really being busy on the ground in Toronto. Classique asks, are you seeing unconditional offers as common again from buyers in Toronto? So you've mentioned in your report, I invite everyone to look at it, that multiple offers are back.
Yeah.
So that would mean probably unconditional offers are back?
Yeah, unconditional. I actually had it in my report. I'm looking at it now. So when I look at low-rise homes, so again, this is the place where we would see unconditional offers more frequently, because condos usually have conditions on reviewing the condo docs. Just last week, just under 80% of homes sold with no conditions. And it's been skyrocketing. I mean, in the fall, I'm looking down at some stats. In the fall, it was about 50% was the most common. 55% of homes were selling with no conditions. Last week, it hit just under 80%. So, and again, this is a function of the fact that the market is just so competitive right now. When we have, such a high number of homes getting multiple offers selling for over asking, those offers tend to be with no conditions.
Okay, we have some other great questions, but I know Dave's waiting. Why don't we get to a bit of a mortgage update with Dave, and hopefully we'll have time to get to more of these great questions coming in.
Sounds great. All right.
Hello.
Mr. LaRock, thank you again for joining us.
Sure.
Yeah,
It's a pleasure.
I thought today would be good to just go over your latest blog post. For those of you who don't follow David, I mean, you can see his blog posts at movesmartly.com. They're quite fantastic. And I mentioned to him before this call, I think we might need like 20 minutes or even half an hour to just unpack one blog post, because there's so much information in there. So maybe why don't you kind of just, walk us through, I mean, your post was about what the US Fed's pause on rate hikes means for the Canadian mortgage market. So maybe if you can just kind of kick things off, and then I'll ask you kind of questions as we go along.
Sure. Well, anyone who follows Canadian mortgage rates, and certainly the people who read my blog, will roll their eyes when they hear me say, because I say it all the time, but I'm going to say it anyway for the uninitiated, that Canadian fixed mortgage rates are priced essentially on Government of Canada bond yields.
Mhm.
And Government of Canada bond yields piggyback on US Treasuries. So as much as we'd like to think that everything in Canada is basically what will determine the direction of our rates, in reality, a lot of the movements that we see in Canadian fixed mortgage rates are a result of US Treasury movements. So we really want to pay attention closely to what happens in the US. And that makes sense when you consider that the vast majority of our trade is with the US, and they are the elephant, and we are the what is it, the mouse sleeping next to the elephant, where we feel every groan and grunt. And if the US has lots of inflation, then we tend to import it over time. So when we look at the US right now, the US was raising rates for longer. They've had more inflation than we've had. Their inflation rate is higher. They're just around 5%. We're getting down pretty close to 3%. In the US, they have their economy is less dependent on the real estate sector, dramatically so.
Mhm.
So, and they have the interest rate. The most interest rate sensitive parts of their economy are smaller on a proportionate basis. So they have more inflation and they're less sensitive to rate hikes.
Okay.
The Fed was still hiking. Their policy rate is about 0.75% right now, higher than ours. And that was basically priced in by the market. And the Fed essentially didn't say we're pausing as overtly as the Bank of Canada did, but they kind of hinted at it in the way they changed their language. Instead of saying we think we'll probably keep raising, they sort of softened their language and said we'll raise as needed. And that pause basically gave the market a lot of relief. Interestingly, though, because the US banking crisis that happened at the beginning of last month drove down US bond yields, it pushed down our bond yields and our mortgage rates. So we had this sort of tailwind where Bank of Canada rate hikes were trying to slow the economy in Canada. The real estate market had slowed. And then we got this free tailwind emanating from blowing up from the south, where low US Treasury, plunging US Treasury yields brought down our Government of Canada bond yields, because the banking crisis basically had everybody fleeing for safety, piling into sovereign bonds, US Treasuries, Canada bond yields. And so that gave our real estate market some of the tailwind that it now clearly has. And when the US Federal Reserve paused, what that meant for bond market investors is now they no longer were as worried about rates going higher, and it increased demand, and it's caused bond yields to drop. Basically, people are saying, if we think this is the top, we're more confident about getting back into bonds. Interestingly, home buyers are often more confident when they can be, when they have line of sight on rates topping out. We saw that, John.
Yeah.
Interestingly, as soon as people heard the Bank of Canada say that it was going to pause and there'd be no further rate hikes over the near term, that seemed to give the bond market some juice, and the real estate market some juice. So we really want to look closely at what's happening in the US to understand what's happening in Canada. And long story short, a Fed pause helps bring bond yields down. In the US is having the same impact on Government of Canada bond yields, which are piggybacking on them and helping to put some downward pressure on our mortgage rates.
Interesting. Now, you had kind of touched on a couple of comments I thought were interesting from economist David Rosenberg in your post. And one was his comment about this is, the fastest rate hiking cycle that we've seen in modern times. So the speed of these rate hikes is kind of nothing we've seen in the past. And further to that, his argument that that on average it takes 10 months after the US bond yield curve inverts before we see a recession. So maybe if you can unpack a little bit about what a yield curve inversion is for the average person who doesn't know, and what that means, and why that tends to signal a recession 10 months out. And the interesting point is, I think, is in addition to him saying that, I think he basically said, or you said in your post, that it was 10 months ago that the yield curve inverted. So we might be due for a recession sooner rather than later.
Yeah, well, there's always that moment, if you remember from the old Roadrunner cartoons, where Wile E. Coyote runs off the cliff and his legs are still spinning and he hasn't looked down yet. So he's suspended in midair, and then he looks down and realizes there's no ground under his feet, and then down he goes. We may be in that Wile E. Coyote moment based on what Rosenberg said, because we've had the steepest rate hikes, but he shows the Fed, but the same would be true of the BOC, because we don't tend to skew too far from what the Fed does. The sharpest series of rate hikes in modern history, if the average is 10 months and we're at 10 months now, then we're probably just haven't looked down yet, and the legs are still spinning. In answer to your question about the bond yield curve normally slopes, if you looked at a chart, from the bottom left up to the top right. Mm-hmm. And essentially, it makes sense to people. If you want to borrow money for a year, it's going to be cheaper than borrowing money for 5 years, which is cheaper than borrowing money for 10 years. Because on the other side of you borrowing that money is someone lending the money. And the person lending the money wants to earn a certain return on their capital. And the longer they put that money out, the more return they want. In part because there's more uncertainty. If you're lending money for 10 years, you're a lot less certain about what inflation will do over that period. And if there's lots of inflation, that erodes your real return, right? Because the higher inflation is, the more of that return, basically you're setting fire to it, because the prices of everything are going up. And when you get your money back, it's worth less than it was when you put it out there in the first place. So just to unpack that, just so people can kind of understand, a normal yield curve, we might see, for example, borrowing or lending for a year at a rate of 2%, whereas if I wanted a mortgage at 5 years, it'd be 5%. So the rate increases as our time horizon increases, right? That's like a normal yield curve. Right. Yes. That is a normal, and again, looking with my finger drawing a chart, the farther out you go, the higher rates get. And that makes sense to people. Yeah. When a yield curve inverts, basically shorter term rates are higher than longer term rates. And we're seeing that today. 1 year fixed rates are offered at 6%, and 5 year fixed rates are offered in the low 4 to high 4% range. Okay. And the reason that's happening, that inversion occurs, because the bond market thinks we're going to get lots more inflation in the next year or two, and that the farther out we get, the lower inflation is going to go. Now, when a bond yield curve inverts, it's typically because there have been a lot of rate hikes, because basically the rate hikes were necessitated by the fact there was lots of inflation. And the inversion of the curve is basically the bond market saying, we think these rate hikes are going to slow the economy. It's going to bring demand down. Inflation will eventually cool. And when that happens, we'll accept the lower return farther out, because we think there'll be less inflation eroding our real returns. Mm-hmm. An inverted yield curve is a sign of an unhealthy economy. There's something wrong when that happens. You shouldn't be willing to accept a lower rate of return for putting your money out longer, and it's a signal. And in fact, there are all kinds of, in economics, you don't find a lot of absolutes. Usually there are opinions on both sides. There's the old joke of, I just want to find a one-handed economist, because you ask an economist a question and they usually say, on the one hand this, but on the other hand that. And one of the most reliable gauges that economists use is the inverted yield curve. If there is any signal that is as close to 100% as it gets, certainly based on the last 50 years, it would be the inversion of the U.S. yield curve signaling a U.S. recession. Again, very, very much the same in Canada. And interestingly, the degree to which the yield curve inverts is also important. And economist David Rosenberg and many other economists have said that when you look at the degree to which the yield curve has inverted, it's 100%. If past is prologue, there's a 100% probability based on past experience that in fact a recession will ensue. Now, that doesn't tell us everything. We don't know will it be a mild recession, will it be a deep recession. Those things have yet to be determined. But again, yield curves, when they invert, signal sharp slowing in the economy. It's certainly expected. In fact, our central bankers want it because they think that we need it to slow the economy. But in answer to your question, that's why it's inverted right now.
Okay, that's super helpful. Now, I have more questions for you, but before I go to my questions, let's hit pause and maybe bring Urmi back and see if we can go through some of the viewer questions or we've had here in the chat.
Thanks, John. Dave, we have quite a few questions. It's been a really unprecedented time for some of these mortgage arrangements with banks. So some are asking about what might happen next. So from Frank Greco, John, please ask Dave if it's true that most bank lenders, will require variable rate borrowers to pay the principal not paid while amortizations were permitted above 30 years at renewal. This could be in the tens of thousands of dollars. Now, maybe first, Dave, you can explain that, banks made arrangements with many mortgage payers to keep their payments the same if they had variable rate mortgages. But that meant, in effect, some of them were not even paying anything more than the interest on their, not even in some cases, not all. So how will that be resolved on renewal?
Okay. So Frank, not to worry, the scenario that you worry about, there is a 0% chance that will happen. I'm happy to reassure you. I'm going to hedge a lot of what I say, but I'm not going to hedge that because there's no chance it'll happen. So just to give a bit of background, there's two types of variable rate mortgages. When variable rates go up, an adjustable variable rate mortgage will adjust. In other words, your payment will go up and you'll keep paying off principal at the same pace. You'll just make a higher payment because the interest portion has gone up when rates rise. There's another kind of variable rate mortgage, and this is most Canadian variable rate mortgages that come with fixed payments. So even though the interest rate rises, all that happens is there's an adjustment where more of the payment goes towards interest and less of the payment goes towards principal. When rates go way up, like they have, people get into a situation where the minimum payment they're making is no longer covering even the cost of interest. Now, most lenders who have fixed payment variables will call you at that point and say, you've got to increase your payment, number one, to at least cover the interest portion. But a few lenders are allowing borrowers to roll that shortfall into the mortgage. And the question I think Frank has is what happens at renewal? Number one, with the borrowers who've been paying interest only, who haven't amortized down the principal as the contract originally expected. And also what happens to the borrowers who've actually seen their mortgage increase and they've gone into what's called a negative amortization scenario, meaning that the mortgage actually grew over the life of the loan. And by the way, you can only increase the mortgage up to 80% of the current value of the property. So only borrowers who have a lot of equity in the property will even have the option of not changing their payment and having the shortfall added to the mortgage each month. So at renewal, it's not entirely clear what will happen. In fact, our banking regulator right now is looking at this, and they've said that they're going to come out with some sort of announcement on how to handle it. Over the short term, the major banks, and they're the ones who have these fixed payment variables, the major banks have been given a lot of flexibility about how they handle these situations. And quite frankly, if you're a bank and the borrower is paying as agreed, and it's a nice property with a decent amount of equity in it, you're probably perfectly happy to let them pay more slowly because you're going to keep the mortgage for longer. And you know, if the borrower is paying as agreed, the longer you keep the mortgage with, the more money you make. So the banks basically make more profit as a result of allowing people to pay off the debt more slowly. At renewal, there's uncertainty now. What will happen? Because if you started with a $300,000 mortgage, and you were supposed to pay $40,000 of it off over a 5-year time horizon, and at renewal you only paid $10,000 off because rates went way up. Frank's question is, are you going to have to write a check for 30 grand? The answer is no chance in Hades. What will happen at renewal is the lender will probably say, we're going to basically treat it like your mortgage balance isn't the 260 it should be. We're going to take the 290 that it is actually, and we're going to offer you a renewal based on that being your mortgage and based on whatever the amortization should be. So if you started out with a 30-year AM and you had a 5-year variable, and it started out with a balance of 300,000, and it's 5 years later, and you've paid off 10,000, you would be offered a 25-year AM on a $290,000 mortgage, based on where rates were at that time. Now, that's not easy for that borrower. They didn't get principal pay down. At renewal, they lose that protection of having to make only the interest payments. At renewal, they have to go back to paying principal and interest and doing so at higher rates. And again, they only paid off a small portion of their mortgage over the whole term. So it's not a good news scenario for those borrowers. But the fear that some people have that the lender's going to say, you've got to write us a big check, a one-time check for, in this example, $30,000, or pay back our money. That scenario doesn't exist. If you're in the lending world, where I worked for about a decade before I became a broker 13 years ago, you don't want to shock people, especially good payers who are making mortgage payments. And again, this scenario where borrowers pay off their debt more slowly, as long as they're making their payments, you're going to make more money because the debt's going to stick around longer. So the fears that you read about online of people being hit with demands for large payments, good payers, not going to happen. No chance.
Okay, but I'm gonna jump in here then. That scenario you gave, someone renewing at say 25 years with their, not just their original balance, but whatever they've accumulated, is going to be a massive shock on their payments, right? So anyone who is doing that, they're going to probably see if they're renewing at today's rates, are probably going to see their payment increase by 50%.
Yep.
Right?
Absolutely. That's why I said it's not a good news scenario. I'm not trying to suggest it isn't something that we should be concerned about and something that isn't going to have some impact on the market. But we're talking about, is Mars going to hit Earth, or is it going to be, is it going to be tough sledding? Mars isn't going to hit Earth, but yeah, it's going to be tough sledding.
Yeah, I mean, it'll be interesting to see what banks do to soften that blow, if anything, because that's going to be a big hit for a lot of people, especially if you have a lot of rental properties, to have that type of payment shock. So that's going to be the interesting trend to keep an eye out, I think, over the next year and a half, if rates stay high.
I agree.
I think that answers actually Wang Xingfu's question. What are the long-term impacts to housing of kicking the growing debt down the road? I'm going to assume this question is not about national debt, but about the debt that you're speaking of.
Well, we're kicking a lot of debt down the road at the government level and the personal level, and the question from a borrower standpoint, a lot of it will depend on what happens with home values. If home values keep going up, then higher debt is manageable because the debt represents a portion of the value of the property. And if the house goes up in value, the whole house goes up in value, then people can oftentimes end up ahead. And if the house keeps going up in value, you can refinance, and there's all kinds of flexibility. Where we hit that wall, I guess we'll go back to that Wile E. Coyote analogy one more time. Wile E. Coyote always seemed to be whipping down the road and not realize there was a cliff in front of him and he'd hit it full speed. That scenario is where real estate prices fall. If we get a 20% drop in real estate prices, all of a sudden, all of this debt outstanding is a much bigger concern for the lenders lending the money. And the flexibility that borrowers have who are being negatively impacted by higher payments and negative amortization mortgages, everything changes if house prices drop by a material degree. But until then, it's all manageable.
All right. So that's a big until then. And hopefully, I think our viewers are asking good questions here. Wang Shifu, we will keep looking at that question because one thing to keep in mind, though, Dave, is what is our exposure overall in Canada? I think one thing we are a little confused about is how many people own what percentages of their homes. For example, Canadians do have a lot of equity in their homes already. Is that correct?
That's right. right now in Canada, only about half of the homes have any debt on them whatsoever. So, it is worth remembering that when people talk about high debt levels. The challenge, though, markets are made at the margins, and the homes that do have debt on them, a larger and larger percentage of them have more and more borrowers who are past a key threshold, which is basically the cost of the debt exceeds 4.5 times their income is less than 4.5 times the cost to service the debt, and that is concerning. Basically, we are the marginal borrower is taking on more debt and the debt represents a larger percentage of their income, and that is definitely a concern. And if house prices keep going up and borrowing rates keep increasing, it's unsustainable. So there's no question. Markets are made at the margin, and the riskiest parts of the borrowing market are increasing at a level that is concerning our regulators, and to a degree that will lead to more mortgage rule changes. And if the market doesn't slow on its own, and right now it's not slowing anymore, that's undeniable, then the regulators are going to step in. And I think people should be aware of that, because I have no doubt that it will happen.
All right. Lots of questions on the table I'm leaving here, but they're good ones. I think you touched on a few with your last response. And we'll have you back, of course, Dave, to keep tracking the situation and perhaps talking, maybe trying to quantify that marginal element. If people have more specific questions, where can they reach you?
They can reach me at my website. Just type in Dave the Mortgage Broker in Google, or go to moreplan.ca. There are also links at the bottom of the posts I write for Move Smartly that link to my website. And by the way, if people want to read, there are some excellent detailed studies on the Bank of Canada's website where they actually do a lot of research and show you empirical data on what is happening at the margins. And you can see for yourselves with their commentary on the areas of the market that are concerning to them.
Yeah, it's interesting you say that. I was just speaking with an economist from the Bank of Canada yesterday, actually, and he brought that up. And Urmi, what we should do is actually share that in the show description notes, a link to it, because it's a very good website. It shows you how the whole mortgage market has changed over time, like what share of mortgages are variable, fixed, what's term, loan to value ratios, like all of this stuff. It's super interesting.
Okay, great. So I've shared in our chat already the link to Dave's latest post, so you can reach him through that. And we will add some show notes like John's talking about.
Awesome.
Thank you, Dave.
All right. Thanks again, Dave. And thank you everybody for your questions. And we will we'll see you next month.
Yeah, I have to say, we will keep answering your questions. So stay tuned to our channel. We may even pick up some of your questions on some of our other shows as well.
Thanks, everyone.